Now, there were certain measures to measure to measure the interest rate risk. The first was duration, which we have already discussed in details. It had this own pros and cons, like it's easy to understand, but maybe it may not capture the full picture. Then we had gap analysis, where we try to understand how, like, it is more important for the banking firms, where they try to measure their assets and liabilities, and if liabilities are higher, then higher interest rate may affect them, because in that case they have to pay more compared to their assets. And if they have higher asset, it would be beneficial for them, because their income would be higher than their obligations. So definitely it is a double-edged sword for them also. So they try to understand this gap analysis, and we try to understand how much they are about to pay, or how much they are about to receive. Then value at risk we already calculated. First we will calculate obviously standard deviation, and once you have standard deviation and confidence level like 95%, 99%, you will calculate the statistic value based on that 95% or 99% confidence level, and just simply multiply standard deviation value with that. You will have your value at risk. Okay. Then it also had its pros and cons, and then we discussed some examples also. First was the gap analysis, how to do gap analysis. So you will have, just for simplicity, one side you will have assets and one side you will have liabilities. Okay, so assets, you will have the loans or the debt you have provided to the borrowers, and the liabilities also you have taken. Okay, or the deposit also. Then you try to keep them in in two separate columns, and understand how much in that particular year you have asset, and how much liabilities you have. Then you will take the differences, and cumulatively you will understand how much loan you, or how much interest you have to pay and you have to receive. And this was the example we discussed. This was the gap analysis. So we kept assets one side, and then we took certain time frame, 0 to 6 months, 6 months to 1 year, then 2, 3, 4, 5. We had assets, we had liabilities, and we had this gap. We had then cumulative gap, and finally at the end of 4 to 5 years we had positive gap, which was we had higher assets compared to the liabilities. So in the fifth year, suppose you have to interest rate goes up, it would be beneficial for the bank, because they will have more interest to receive than the interest to pay. Then this was the second example we already discussed there. Then value at risk. So value at risk, as I said, it is a statistical measure that estimates the potential loss that an investor's or portfolio may experience over a given period of time at a specific confidence level. So in simple terms, we were discussing that day ki this is the maximum loss you can have. Maximum loss of your investment you can have, given a change in the condition and with a certain level of confidence. You want to have certain confidence, okay? Okay, what is the probability, or what with what probability I will lose a particular amount. So suppose you say with the 95% probability, the value at risk is 5,000, meaning there are 95% of the times your loss from the portfolio will not cross 5,000. Or you can say there are only 5% chances that your loss will cross 5,000. Okay, so either way you can interpret it. So this is called value at risk. This is the top bottom with downside risk we call it, because it tries to measure the ultimate or maximum loss you can have. Okay, this was the value at risk, and I think for that also we took live data. I think I remember we took live data from stock market or bond market, and then we tried to calculate. I don't know if I have that data right now. No, the data is not there, but we solved it, right? Like we took data or something. You remember? Atul, you were there in the volatility in the war with this
Yeah,
class.
yeah, we calculated the war. We calculated. We
We
did
took, I think,
calculate that.
live data, right?
Probably.
Uh,
I think
yeah, because
I
data
do
is not
recall
there.
we calculated. Actually, this war calculation we also did in another subject, on financial risk management paper also we did it
Yeah, yeah.
actually.
Okay. So this was already covered. Now coming to this thing, then we had war
So
components
just
that it.
one doubt on that duration and gap analysis case. So what is the fundamental difference between the two in the sense that my sensitivity to the interest rate risk is given by both, or what is gap analysis really telling me? I mean, like I thought duration is telling me the sensitivity, right? 1% change in interest rate, how much percentage change in my bond prices. What
Correct.
would gap analysis give me a view?
Gap analysis will give you a view that how much assets and liability differences you have, and based on that, so you can understand gap analysis in such a way that you are trying to understand this year whether you are going to pay more or going to pay less. So in that sense, if you think your assets are more, then definitely you are going to receive, and based on that, you will assume if interest rate is going up, I don't care. Like for me, it is just beneficial. So both are trying to measure the interest rate in such a way कि given the interest rate change, what will be the price that will tell duration. Duration will tell you how much price may go change because of change in interest rate, right? It will tell you in percentage format. That's it, enough. But
So for a
coming to the
bank,
yes,
will duration analysis
yes,
give me a view on how much my interest income will get impacted? Like, in gap analysis, you've clearly mentioned that changes in the interest rate could affect net interest income, right?
yeah,
So essentially, by doing a gap analysis, I'm trying to see, if my interest rate changes, how much my net interest income will get impacted. But will
yes,
duration also give me the same view?
no. So what here I'm doing, it depends upon the who is using what. So for you are
Hmm.
investing in the bond, okay. So you will definitely go with the duration because you want to see you have invested in bonds. Gap analysis is looks from the perspective of assets and liabilities. Duration will not tell the same thing which gap analysis will tell. So the users are different. For gap
Right.
analysis, it is more useful for the banking sector. Duration is more useful for me and you who are going to invest in the bond market and all. It will become interested for bank also if their some of their money is going to invest in the bond. So it is just not either duration or gap, they can use the combination of both. So bank can see that they have invested certain amounts in bond and how based on duration, how it is going to affect their bond price. Okay. Or me and you can definitely use duration. For me and you, gap analysis won't make much sense because we don't have assets or liabilities like this. So it depends upon the users, also, like who is going to use this.
Precisely. So, I mean, that's why my question was mainly there only that, will a bank
Mm-hmm.
use duration analysis to figure out, what is the impact on their net interest income, basically, which is based on asset liability mismatch,
Yeah.
how much a change in the interest rate will impact their net interest income. Will bank use a duration tool, or it will always use a gap analysis tool?
No, not always. Not even duration and gap only. There are thousand types of things they use actually.
But
Just
will
this
it they
is just
use duration? Will they
duration they
use
use. I'm
duration?
saying they can plug in duration with gap. See, we both can see here. If you plug in duration with gap analysis, you already have data. Okay, your assets and loan or whatever is you have higher. Now use duration analysis also as a complementary and see forward looking approach how may it affect your
Hmm.
bond price, or if it is going to affect your bond price, then try to see in your asset side. So suppose you have bond or you have bonds, then you can do some advanced analysis also. No, based you can do scenario analysis in that case. So you can
Okay,
change your duration. Based on duration, you can see how it is going to affect your price and ultimately how it is going to affect your gap.
sure, got you.
Like understood. Like for example, you have bond in your asset side, right?
No, no,
One
I
gap
understood
analysis.
you. I mean, you can use both of them.
Yes.
I mean, it's not that, it is, I mean, as a tool, both can be used. Which one is used, or, they use it in combination for different instruments, that could be up to the particular user
Yeah.
here.
Purpose, objective. Like
Yeah,
what is the objective
exactly.
of doing
Got you. Hmm.
that? So we finished with gap analysis, value at risk. Value at risk we had components we discussed. It should be time, it should have time horizon, it should have confidence level, what is the portfolio value or investment amount. You need to calculate historical data, you need to download the historical data also, then you calculate volatility, then you use certain methodology, either covariance method, historical simulation, or Monte Carlo simulation. Monte Carlo simulation and all we did not discuss because we said it is bit advanced and requires some other things which generally should be covered in your FRM. I don't know whether they covered it or not, but Monte Carlo simulations is like bit Excel advanced kind of thing. But did they cover Monte Carlo simulation simulation FRM?
No, sir, just theory.
Only theory,
I
yeah, exactly. In FRM, we only had theory,
I
no,
literally want to cover this. I love this Monte Carlo simulation. I used to have the panic of this Monte Carlo simulation. So, for my one of my objective, I tried to calculate Monte Carlo. So, I'm not promising, but someday I literally, if any of you, we will have a class. I can calculate Monte Carlo simulation also for you guys. At least you should have this understanding because these kind of see. I'm not saying I'm very expert in this Monte Carlo simulation, but I have some experience with that, so I can share my experience with you guys in a separate class. So that would be useful for your MBA and post MBA because theory, like you can go and read in the book also. I don't know what is the purpose. Like, no, that is purpose is there. I'm not criticizing that, but I'm saying if little bit practical approach is there, then it would be good. Like for example, we everyone can calculate that day also I told you just need to download the data, put STDV, your standard deviation will come. But if we can do hands-on practice, that will be more useful, isn't it? So I'll try, like I'll see if I can somehow cover this Monte Carlo simulation. If you guys are interested, then we can see some. I will download some Excel solver and all, and we'll try to calculate it. Is it okay? I'll see.
yeah,
Yes,
sure,
yes, sir.
definitely.
Yes. Yeah, because that is very important for your placement perspective also. And if you're going to do job in corporate and all these things will come. Calculate Monte Carlo simulation, do this simulation, that simulation. So you should not get panic there actually. Um, okay. So, but my job was to calculate variance covariance method that we covered and historical simulation, that's historical volatility only we calculated. Monte Carlo simulation, I'll see. I'll ask Juhi ma'am also how can I cover it. Okay. Someday I'll take some extra 1 hour class without anything and then we'll see. Okay. Okay. Then, okay, these are all we covered, like what is purchasing power risk. This is nothing but the risk arise because of change in inflation or which because of that your purchasing power is going down or majorly what we covered under it, like it is mostly inflation risks which actually affects your purchasing power and which because of which you may lose the value of your investment. Okay, so it becomes more important in the concept of fixed income market. Why? Because unlike stock market and all, there's no thing. Okay, you may get return the way you get in stock market. You have a fixed coupon, and it is mostly dependent upon the market interest rate. So if market interest rate is not in a situation or is not sufficient enough to cover your inflation, then definitely you are going to lose value on your investment, and it will be very difficult for you, especially for your old age. You cannot accumulate enough money. Okay, so you have to take care of that also. What is the rate of inflation in the economy? Like, how can you beat that inflation? Okay, so and especially it happened now also. That's why this fixed deposit and all, you have to keep tracking them. Like you are investing in a fixed deposit where they have promised you they will pay you 5.7% for 365 days or something. But please keep track like what is the inflation rate? Can you beat that? Like that's the only slight difference between the smart investor and like risk averse investor. So that's why people started building up portfolios. Now, suppose you have 1 lakh rupees, they try to invest in triple B bonds also. They try to invest in triple A bonds also. Some money in equity, some money in FD. And FD somehow become least popular if you are not, if you are aware of inflation kind of situation because somehow it touched 6% also recently. And some of the FDs are only paying 7% only. So there's just 1% improvement is there. You are saving just purchasing power of your money, but you are not earning enough. Okay, then we have, okay, it affects your long-term finance planning. Definitely, it is essential to consider. Like if you are thinking about your long-term financing, as I said, you need to understand how it is going to be future, how much money exactly you want for your retirement fund, how much money you want that you can get a sufficient pension and comfortable days in your old life and all. So that's thing you have to consider when you are talking about saving for long-term and all. And inflation, what is the inflation? How it is affecting your purchasing power? This scenario we discussed is just a simple scenario. The low inflation, it's not going to affect your money much, but inflation, if it was higher, like 5% and all, it actually eroded the value of your investment, and you had less money in your hand compared to time when inflation was low. So it was just a simple example we discussed that day. Then we discussed about the default risk. Default risk in the first slide also, as I said, it is like this that the investors or the borrowers is not in a situation to pay its obligation. Okay, that he's not able to fulfill his obligation or her obligation, and they don't have enough money to pay. And it can happen at a country level, it can happen at firm level, it can happen with individual also. So every day, that day also I was telling you, just open the business standard paper from the back side, you will have 2 3 pages covered with this, that bank is issuing show court notice, this thing about people and all, that they are not able to pay the 6,000 crore rupees or 1,000 crore rupees, or this person could not pay 35 crore rupees and all. So like it's kind of situation where just simple way you are not able to pay the shit. You kind of, it could be because of your uh, market condition for the firms, or it could be because of economic scenario for the country or the firm business firm. It could be your personal reasons, that you have lost your money or you have lost your insurance and all these things at personal level. There could be multiple reasons that you are not in a situation to pay. It could be a willful default also. There are people who actually try to um say, okay, we don't have money, and we willingly we are filing for bankruptcy and all, so they don't need to pay and all. Nowadays they are putting some restrictions, regulations are being bit strict to identify who are willful defaulters and how to control them. These were the newspaper articles I said, that how this is surging, Indian consumers borrowing surging, so in case it is increasing the default risk also. How interest rates are pushing US corporate into default in China. And you please try to read whenever you get extra time. China is becoming sometime, I think, interesting case. Their default cases are rising actually. So you see some news and all. You will see that this is interesting case. And after pandemic, actually, this is the situation across the uh, world also. So it has personal level, firm level, or country level, it is happening in that case also. The most recent case we had, I think, till now, Greece. I don't know after Greece if any country went on default or something when it's come to interest payment on principal payment. But recent was the Greece default only, or Eurozone debt crisis we call it. Around it happened in
So what was
2011.
the reason for the Greece default, sir?
Exact reason I don't know, but somehow they had too much debt they took. They try to fund their some activities, like, and given that the too much loan, they were not able to pay interest payment. So there was a kind of chain reaction actually, that they could not pay interest first, and then they started getting default on their euro dollar bonds also. And somehow CDS spread default also was a reason, which actually economies were recovering from the 2008 financial crisis, because only there are 3 years difference between GFC and Eurozone debt crisis.
Okay, I
Okay.
see. I understand. So it is a
Uh,
impact of that also. No, the reason I was asking was that being a country, I mean, they could not have printed money to service that default, although that may not be the best option to go with. But I don't know, given that they would have that tool with them to service a default, they would not have preferred to go that way,
no, it depends like
or
how much.
or
Yeah,
European Union would not
please
have
let
allowed
it.
that.
No, no, please tell me what were you saying?
No, I was saying that if being at a country level, the country is defaulting. I mean, the country would have always have their central bank would have always have an option to print money, right? I mean, and service the default.
Mm-hmm.
Now, they have not taken that path and instead defaulted. But would not that have been option with them? I mean, to just to print
No,
the money and
but what money, but what currency they will print? This will lead to inflation. So suppose they are dealing in euros, but Greece doesn't have sole right over printing euro,
exactly
and their
that's where
own.
I was coming. That European Union would not have allowed them, right?
No,
Had
because
had
European
they,
Union were struggling that time.
yeah, hmm,
And
yeah,
if they had allowed printing more money, it would have been a higher inflation case. Not only Greece, so many countries went on default. So Greece was facing one more crisis there. That time unemployment rate was very high there. Their trade deficit was huge, and to compensate the trade deficit, they started borrowing more. Okay. Then US subprime crisis, actually that time it was one of the reason, because just 3 years and US economy itself could not recover around 2010 or 20. I think in second tenure of Obama or something, then only they started showing some recovery sign. So European Union could not help that time. They cannot allow them to print euro currency and then go and recover your default.
I agree.
You're right.
I
They did
agree.
not allow that time. And if you see that time, you see Greece trade deficit. It was too much that time. And for a small economy, doesn't matter how developed they are. See, for 1 lakh, even 10,000 are unemployed. And unemployed, it is 10%. No, for euro, and their economy was actually struggling that time already, and they could not pay. Europe did not allow them to use their euro currency and all. So multiple reasons were there.
Got you. Yeah.
But main reason generally they say it is global financial crisis only actually, because the time was very less between those two crises. Okay, then we discussed about what are the consequences of default. There are multiple consequences. We have you will lose the value of your principal, you will miss the interest payment. The very first case in the very first class we discussed about what happened with Russia and Evergrande crisis. Then what are the factors which affect the default risk? Is like first is the credit worthiness of the issuer, how good you are. Okay, if you are like for example bond issued by government, they consider them safe haven assets also, because we consider government will not go default, but it is some kind of contradictory the things we were discussing just 2 minutes back. So, but this is a rare phenomena we can consider. Government generally does not go on default, but so that's why see ultimately we cannot do anything even government goes on default. But the government guarantee is the biggest guarantee, and that's why we consider them the risk-free bond and all something. So that if the bond issued by government, they will have more credit worthiness. For domestic consumption, they can do that, Atul, what you were discussing. So when domestically it is happening, they may say they may print more money, little bit. So that's why in India also it happens. Sometimes they print more money to compensate that the budget deficit sometime. But when it comes to foreign loan and all, then it becomes very difficult because nobody is going to accept INR to compensate them for their dollar default. Okay, so that happens domestically. They try to do that. They try to print out the money and then try to compensate that. But whenever it happens, it always leads to inflation. So you have to make a very strong and wide decision. And where's the trade-off? Whether your economy is in a situation that it can control the inflation. Like for example, I think you might have heard about Zimbabwe inflation case or all these things. So if inflation goes up to a limit, what is happening
Yeah,
in
we have.
Zimbabwe?
Yes,
Yeah,
we
so
have. Yeah.
you will issue
Mm.
10 trillion US dollar or all these things. So
Right.
um, so you have to see like there's always a trade-off whether you can recover from that inflation, because once this is out of your hand, it is very difficult to control it. Then economic conditions also we discussed. Okay, that if the economic condition is going bad or economy is not doing proper, then there are chances that you may lose or the default probability may be high, which is happening now also. ILF and F case, I think I discussed with you. I shared that article also already with you, right? Today also again I'll share it. Then you have how to manage default risk. The first is diversification. Obviously, never put all the potatoes in a single bowl. Then you have focus on credit quality, and then you have to put like for the long-term bond and all you have to see. I don't know how long-term bond helps, but I don't know why it is a reason that if you hold bonds until maturity, it can reduce default risk. Because no, when you hold bonds, so that's how sometimes a good thing to discuss about certain things. I cannot just teach you what is written here, but you just discuss about it. When the some time back the theory is saying longer the maturity, higher would be the uncertainty, right? So if uncertainty is higher, I don't know how you if invest for the long term, how it is going to reduce your default probability. Okay, they give certain reasons in favor also, that issuer experience temporary financial difficulty, they might have time to recover, but on personal level. But in a firm level and all, if you invest in a company for a long term things and all, that risk is always there. But on personal level, you can say I need more time and I can pay and all. But if you cannot pay now, I don't know how it is going to affect in the long term. Okay, so that is different things. So whenever you read all these things, you just read it very carefully and very critically analyze all these things, because you are already in MBA now. Whatever is written in the book or whatever is written in the given in the concept, just don't read it. And if you find okay, this I'm finding a bit contradictory, or if I'm finding it bit wrong, you just discuss with your faculty, discuss with me, or discuss with this, and then make your own decisions. Okay, because those who wrote the book, they also are author, or they are also MBA, or they are also PhD, they are also like that. Okay, so critically start critically analyzing the situation. That I like about you also, Atu. You literally discuss thing, and that is a very good quality actually a student should have. Okay, so take one more appreciation from my side.
Thank you,
Okay,
sir.
let's so then that's true. Like we there's a focus also, especially now we are attending some lectures. We are also being taught you cannot just go with the traditional ways of teaching, where the thing should be you just imposing something on the students based on what you have read in the book. Neither you are open to take any discussion from their side, or neither you are willing to criticize the concept which is given in the book. Other, if it is the case, nobody would have dared to criticize CAPM model. Nobody would have dared to criticize Modigliani and Miller model. But we all know that they have their own disadvantages. You cannot openly apply Modigliani model. You cannot apply CAPM model openly and all. And that's how they start bringing their own research. Then Pharma French come. He said no. CAPM cannot be the only factor who we can analyze the mark expected return. We can have three factors model. Then people start to know how three factors only there. Only there could be five factors which is affecting market return or expected return. So that's how you develop the research thinking. Okay, no, whatever it is written, I cannot just blindly follow it and say, okay, it is the case. That's where my research starts. So one of the objective of my research were like they said, credit spread is being affected just by bond specific factors. Like, sorry, I'm just going out of track, but I'm telling you a little bit interesting thing here. Uh, so literature was telling that credit spread, which is the difference between the sovereign corporate bond and a sovereign bond of similar maturity, is happening because of bond specific factors like bond duration, bond maturity, or trading volume, and so on. But when we started analyzing this in the context of India, then in the context of China, so my study was on multiple countries like India, China, Korea, Malaysia, and Taiwan. What we realize actually macroeconomic factors or even stock market factors affected credit spread in more significant way, but at the same time it was still not consistent. Even short term the factors were different, medium term factors were different, long term factors were different. Then for China, factors were different. For Malaysia, factors were different. So we came to a conclusion that no, you cannot generalize the results. Okay, credit spread is being affected just because of bond specific factors. There are thousand factors which may affect, and these thousand factors also vary according to the bond's maturity. So that's how you start your research also and came up with certain conclusion and all. So otherwise, I could have also accepted, yeah, bond factors are only responsible for credit spread, but no, still there are error terms or constant term which is significant. You can say, but I did apart from that there could be multiple factors which may affect. Now they suggested me you should have considered oil price volatility also, that oil price volatility may also affect your credit spread in a significant manner. So that we will think, okay, how can we do that in future? So that's how I'm just a small lesson from my side because I'm concluding this session today. That whenever you start reading from now onward, just start analyzing critically. I'm very open. Like you can criticize on my face. Okay, sir, you are wrong here. I will definitely accept. I'm not the superior who has everything of fixed income market. It's just a ocean. I have one drop or something. So you can openly criticize, you can tell me, no, sir, I don't think so. You are saying this right, and we can discuss this. That's how discussion happens, and that's how the new teaching methods are like rising. You just are not based on traditional book knowledge and all. Okay, sorry, I just went out of track for some time. Okay, then we had how to measure this risk. We had different discussed that time. Either you can go ahead with the credit ratings, which can give you indicators, like we discussed. There are different credit ratings. It could be triple A, triple B, A plus, and all. Based on that, you generally try to identify that whether the security is risky or less risky. That is very clear. Higher the credit rating, lower would be the default risk. Then you have yield to maturity kind of situation that is also provides an indicator. If yield is increasing, definitely the demand for that kind of bond is increasing, decreasing, or either the default risk is high, that's why they are trying to compensate with higher yield. Okay. Then we had financial ratio. We discussed about you can talk to debt to equity ratio. You can go ahead with you can interest coverage ratio or profitability ratio, and all these things you can consider into account, and then you can make a wise decision how it uh, works. Okay. Then you have different market signals also. How industry is doing. How what is happening. That day we were discussing like. Government suddenly started announcing, okay, we will go ahead with 100 smart cities, but that smart cities project may affect so many things around it. It may affect cement industry, iron industry, workers, so many things it may affect. So okay, you have to catch that market signals also, how the market is behaving, how the industry in general is behaving. And then you have default probability advanced model, like you use algorithm or historical data. One of the example we discussed in upcoming slides. For that, there were certain terms we discussed: probability of default, distant default. These are the theories you can we discussed that day. You can go ahead with that also. This was the one example we discussed about default risk calculation using a simplified model. So we had multiple scenarios. What did we do? So we have historical default rates and we have company specific factors. We have debt to equity, interest coverage ratio. We took all these things into account. Then we had a basic default rate. And then whatever the factors we have given, we adjusted our default rate accordingly. And finally, we came up with a default rate, I think, uh, 0.42 hypothetical value we came up when we multiplied this all these three factors. Your what did we do? Okay, we took base default rate, we took leverage adjustment factor, and we took interest coverage adjustment factor. We multiplied all these things and came out with 4.42%, and that's was our default probability. So this is step by step, is clearly one by one thing is mentioned. That's why that day also I told you, that's why I'm writing too much in the PPT. Generally I don't write anything in the PPT much, because then you can read these PPTs to save your time and just go ahead with this one by one with all these things. Then some crisis, I gave some example. Evergrande crisis we have already discussed. Then White Petroleum Corporation. Then this whatever JCP, Penny, and all. This just for your understanding only. You can read in the newspaper also all these things. Then wheel for defaulters. These are also from newspapers and all. Times of India, Times of India. These were actually part of to make your understanding more comprehensive. Vijay Mallya's loan default case and all, which I ask you to either go through newspaper or just read this. These are some interesting cases which tells you how default risk is increasing year by year. Then probability of default. Okay, the probability of default to calculate, we went with certain step. The first step was to gather the historical data. Second, you will divide the data into two part: training set or you will the testing set. Training set would be the data where you will try to build the model. Once you have built this model, you will go for the testing or main data and you will apply that, and that's how you will calculate your default probability. Then the third step will be model building. In model building, I told you one thing is logistic regression. In brief, I discussed that more logistic regression also, that when the dependent variable is between 0 and 1, you go ahead with the logistic regression. Based on logistic regression, you calculate your coefficient. Once you have this coefficient, you put all these value into formula of the probability default, which is PD is equal to 1 divided by 1 plus e power minus inverse of z. So then what did I tell you? Generally, most of the information will be given. What information will be given? We will discuss with this example. So there was certain information was giving: loan amount, interest rate, credit score, debt to income ratio, default. Yes or no, which is your dependent variable. Based on the left hand side information, you want to see what is the probability of being default for the particular company. So that again went we ahead with the process. You developed a model, you calculated the value for loan amount coefficient, interest rate coefficient, credit score coefficient, and debt to income ratio coefficient. If you forgot, I told you that the coefficient is nothing. Given a 1% in loan amount, what is the probability of default? Given a 1% in interest rate, what is the probability of default? Given a 1% change in credit rate, what is the probability of default? Given the change in debt to income, what is the probability of default? These coefficient, once you have calculated, you have put you got another loan implication, and these factors, like these you already have kept in a pocket safe. Now new person came and applied for loan, you took all the data, and based on your historical values you put his value and calculated his probability of default, which was 90.7%. That is, the probability of default is very high, and that's how we calculated probability of default. This was the summary of the chapter. CDS we covered. Then unit 4. Okay, so like wait, let me see. Just a second. Okay, so unit 4 I will just try to cover in max to max in 15 minutes, and then we will discuss about your exam pattern also. and we try to. I'm extremely sorry, but 5 hours is literally very less to cover this 18 to 20 hours of class. Okay, so I'm trying my best. I'm sorry, I'm little bit fast, but that's how I can save your time and my time also. Okay, but some of these things are specifically are theory only. So go with the PPT. Please go with the PPT carefully. If you can go with the PPT itself, there would be like many things you will cover. For example. Okay, so and I think recordings are already there. We discussed everything in too detail when we were discussing unit by unit. So you can ask Atul, you can take help from Atul. He's very good at it. Bhavna has been constant in all the classes. You can take her help also. And you try to cover. I'm pretty sure doesn't matter how much you say, but the speed with which we are covering is just a revision class. And in revision class, you cannot assume that you will get all the things in detail. That is very true. Okay, so I'll try again. How can we cover this unit 4? And with this, the chapter will be closed. This I gave you as a as a exercise only that you should have some understanding of portfolio return. I just tried to cover it that time. You have already covered in your SAPM how to calculate portfolio return. First, you will calculate for individual security. Then you will calculate the weight and multiplied weight with the return. You will have portfolio return. Okay. Then we were discussing about active investment strategies and passive investment strategies. So active investment strategies, not management, actually investment strategies are investment approach where fund managers or individual investors try to outperform a benchmark index by carefully selecting and managing a portfolio assets. Here just go with the words. You are actively involved with your money, you are actively involved with your investment and actively participating in the market in a hope that you can beat the market and can get extra return. You are not dependent on anything, you are dependent on your own research, you are doing actively, and based on that you want to beat the market or outperform a benchmark index by calculating extra return. The uh, main things which were covered under in active investment strategies are fundamental analysis and technical analysis. I shared two study material here also. Again, today again I will share. Then you have growth investing, fundamental analysis and technical analysis. We discussed in detail that day also, but you might have heard it in SAPM. Fundamental analysis is more about fundamentals of a company from the perspective of industry, economy, and company in general. Okay, you take all these three factors and do an in-depth research of all these things, and then come up with certain conclusion whether this asset is overvalued or undervalued, whether you should go to invest in this particular company share or not. Technical analysis is more about like trend charts and all patterns. You try to identify what is happening in the current market, and based on the charts, trend, and all, you try to come up with certain things where you should invest, where should you exit the market. That day we were discussing about behavioral aspect also, like how it is goes up and down based on our human tendency or human lalach or whatever you call it. But you have to be very pro and understanding about these charts, patterns, and all. Do some analysis, and based on that, you try to come up with certain things. Okay, where it is bubble, where you have to exit, where it is the bottom. Okay, this is the bottom. Now price will start going up, and you have to invest in. Apart from that, you have to have other understanding, and combined with fundamental analysis, your research would be deep. Then we have growth investing, like you will focus only on the companies with high growth potential, but that also involves your fundamental analysis. Otherwise, how do you know that the company has a high growth potential and all? Okay, then you had value investing, sector rotation, like you will keep rotating the sectors. That day we were discussing, like sometimes it happened. Okay, some good thing is happening in cement industry, so you will definitely be in cement industry. Pandemic actually positively affected the pharma industry, so you will shift to the pharma industries. So you have to see which sectors is doing well, and accordingly you have to actively involve yourself. You have to keep an eye. There were so many people who actually, I remember in my circle, they predicted that this time pharma company shares are going to up and they literally earn very well. So, or they did very good job with their investment. Okay, so that is actually called in practical what is active investing and all, active investment strategies and all. Then there is a rising trend about social responsible investing, that you will invest only on those companies which are actually actively involved or following ESG protocols. They are very sensitive to the environmental aspect, social aspect, or governance aspect. They take care of human rights. They don't violate that. They are very good with protecting environments. And also these kind of, there are certain investors, and it is very popular nowadays in European Union and all. That's why they are coming up with certain benchmark like CS triple D, ES, and this. They are actively following IFRS, OECD. I told you that day. MNE Enterprise as ESG benchmarks are there. So they are actively involving. Even the investors are very well aware there that they have to invest, or the reputation of the company will be high if the company is particularly concerned about ESG factors. Okay, then activist investing, like what is this strategy involved taking an active role in influencing the management of a company. Okay, like you generally buy a shares or take a large stake in a company so that you can influence the decision of a company. But that is, I don't know, this is rare. Like for that, who can do that? That unless you are a very business tycoon and all, I don't know. But these are strategies which are mostly comes under active investment strategy. Then you have, we discussed about fundamental analysis here in details. Then what are the key aspects of fundamental analysis? Like we discussed in brief: macroeconomic analysis, industry analysis, and company analysis. Under company analysis, you do financial statement analysis, management analysis, and competitive analysis. Then you use certain valuation technique and then come up with the decision whether you have to invest in the particular stock or not. Then we discuss what are the benefits of fundamental analysis. There are certain limitations also. Fundamental, it is long-term focus, it reduces the risk, and also uncovers the hidden gems, because you don't know unless you do fundamental analysis whether the stock is overvalued or undervalued. There are similarly limitation. It is considered the market is efficient, but there could be so many changes take place which can affect the fundamentals of a company. It doesn't cover unforeseen event, like you have done fundamental analysis in December 2019, but you did not know in January the COVID-19 pandemic will come. Okay, so your entire fundamental analysis is gone. Whatever you have done for a particular company, maybe that company was severely affected in January 2020. So that's how fundamental analysis doesn't cover unforeseen event. That's why it is plugged with the trend analysis. Even that also sometime may not cover. It is subjective, obviously, because it takes only financial data and the ratio and all these things. So that has its own limitation. Okay. Then technical analysis we discussed, it is nothing but you take the current information about charts, patterns, indicators, and all, and based on this trend and all, you try to come up with certain decisions when to enter the market and when to exit the market. There are also chart technical analysis has also had its own benefits, like it identify trading opportunities. It has it actually, yeah, that is very true. Technical analysis has more understanding of market sentiments, and like volatility index is also part of Atul technical analysis actually. So then we have risk management. Then limitation also it has, it is not very predictive because past information is not guarantee of future always. Okay, it is also subjective, and also it is self-fulfilling prophecy. Like if enough traders are dependent on same technical signals, their buying or selling activity may be influenced by that price movement, or maybe it is like you start following like the crowd and all these things. So you have to be very careful about around that. Okay, then passive investment strategy. In sum, I will tell you what is this passive investment strategy. You yourself is not actively involved, but you follow certain benchmarks. You follow either Sensex, you follow either Nifty 50, you follow Tata ETF fund or Tata this fund. So you align your objective with the particular investment, and you think, okay, there are market investors, there are managers and all these things, they have active and better knowledge, and I just want to go ahead with that trend only. For that you don't need to put much effort, you don't need to put extra research cost and all, and your investment anyway will be diversified because that index itself is very diversified. That's why people generally, those who directly don't want to invest in equity, they just directly go and invest in mutual funds, because mutual fund is being taken care of by mutual fund managers, fund managers and all. And that comes under passive investment strategies. Okay, you yourself do not actively involve yourself, but you are dependent on the market index or market trend. Yeah, some of the common which we discussed: index fund, exchange traded funds, and what were the benefits, like it has lower cost, diversification is better, simplicity, long term performance and all. So, Atul, I think you were asking that the exchange traded funds are also being measured by fund managers, right? I don't know, some similar question you asked that day. So ETF also had fund managers actually. That's why I think I wanted to tell. Okay, these are some drawbacks of passive investing. It's average market. It gives only average market returns because you are just focusing on index, and that index is very diversified. So you are dependent on that market sector. Just a second. So you are dependent on the bank, those indices and all, and obviously you cannot beat the market. You can only beat the market when you are taking actively decision, doing your fundamental and technical analysis. You have limited control, yes, and you have less excitement because you yourself is not as an investor is involved into it, but you are dependent upon on the market indices and all. So this is generally useful for the people who are a bit risk averse or who are new in the market or who are long-term investor and they don't have time to deal every day and actively involved in the trading. So that's why people just put either Sensex or Nifty fund or something and then blue chip companies fund and all, let the market take care of itself and they just go ahead with the flow. Okay, then we discussed about bond indices. Bond indices is nothing, yeah, similar to like your equity indices, but instead of identifying like trend in the equity market, it identifies how bond market is performing, how the overall bond market is performing, and it could be like it could be for sovereign bond, it could be for corporate bonds, or it could be for a particular segment of bond. It could be triple A rated bond, it could be triple B rated bond, it could be BB plus bond. Even if you go to NSE website, there would be market archive. In that market archive, you can check the bond indices. It will give you monthly data of the bond indices, how the overall bond market is doing. Okay, so like we have different type of bond, like we have Bloomberg, Barclay, US aggregated bond index. What this index tells you, the way same in Sensex tells you. So Sensex tells you about the market performance of 30 companies at BSE. Okay, similarly, Nifty 50 tells you the performance or tracks the performance of 50 companies by market capitalization at National Stock Exchange. Similarly, if there is a bond indices, suppose a Bloomberg or Barclay US aggregate bond indices, what does they do? They cover certain bonds like 30 bonds or 40 bonds from that market sector and track the performance. Based on that to try to identify what is happening in the bond market, how bond market is behaving. Okay, that is come under bond index. To calculate bond index, you need to have certain knowledge. Like first you need to define your definition, what indices or what kind of bonds you are including in that index, what assets you are including in that index. Then based on that, there is eligibility criteria that there is a particular type of bond with X amount of money should be included in that indices. Then based on that, you select the security and you calculate the index. Okay, once every month there would be some security which will be excluded from the index and will be included. There would be some indices which prices will be high. You will adjust accordingly. This is called the practice of rebalancing, and accordingly then at the end of month you will calculate the return. Okay, so these are the steps under you use bond indices. This was the example. Just read it. Simple step. I have forwarded here. And this was the case I discussed with you guys. Today again, I will share it. This is a newspaper article, nothing else. With that, your unit 4 was also over. And just a second. Hmm. So thank you. So sorry, first of all, like it was too quick, but it was a revision class. So I had to go little bit quickly. So sorry for that. But like yesterday, one of the student from your class contacted me. He had some doubt, so I tried to solve that. Same way, any of you has any doubt, my mail ID is already there. You just drop me mail anytime and just fix some time where we can discuss whatever is not coming to you or whatever you want to discuss on. So I'm open to everyone. You just let me know. So today it was 5 hours. We had to cover like 18 to 19 hours. So you cannot expect that मैं थोड़ा slow जाऊं, but otherwise would have not have, but इतना तेज जाने के बाद I think 9:52 हो गया. So we will try to cover, we have covered this 4 units. One unit was covered by Manisha ma'am. तो प्लीज अगर किसी को भी कोई डाउट हो तो मेरा मेल आईडी है, मैंने ऑलरेडी दिया हुआ है, तो आप प्लीज मेरे को कभी भी कॉल कर लेना और कभी भी मेरे को मेल ड्रॉप कर देना, ठीक है। एनी डाउट कुछ पूछना है तो बताओ। एग्जाम का किसी को पूछना था? एग्जाम में आपका केस स्टडी होगा एक, जो केस स्टडी काइंड ऑफ मैंने एक बार सोल्व कराया था आप लोगों को, कि आई थिंक तुम लोगों क्लास में दिया था मैंने कि that kind of you can read that case study and some MCQs may be there or some small question. MCQ may not be there, but you will have some theory question, detailed theory questions. So it would be mix, उसमें कुछ theory होगा, उसमें कुछ numericals होगा, केस स्टडी डेफिनेटली होगा। तो केस स्टडी सिंपल होगा, सिंपल इन द सेंस कि ऐसे नहीं कि इट इज आउट ऑफ द सिलेबस। जो आप लोगों ने बॉन्ड वैल्यूएशन, बॉन्ड प्राइसिंग, वॉलेटिलिटी ये सब कवर किया है, इसी में से कोई केस स्टडी टाइप का होगा एंड यू हैव टू सॉल्व दैट। ओके, सो वो ज्यादा नहीं है, वो ऐसे ही होगा, बट मिक्स होगा, थ्योरी भी होगा और न्यूमेरिकल्स भी होगा, बिकॉज सम पीपल आर गुड इन थ्योरी, सम पीपल आर गुड इन न्यूमेरिकल्स। सो वो मिक्स होगा, ठीक है। और कोई डाउट हो तो आप प्लीज पूछ लो।
Numericals, how much it would be like? How many questions would be in numericals?
हाँ वही बोल रहा हूँ, तो ये थोड़ा मिक्स होगा, मतलब अगर 50% आपका थ्योरी है तो 50% न्यूमेरिकल्स होगा।
Okay, okay.
हम्म, और इट कुड बी 60% न्यूमेरिकल्स और 40% थ्योरी, ऐसा भी हो सकता है,
Hmm. Okay.
ठीक है। क्योंकि केस स्टडी में डेफिनेटली न्यूमेरिकल्स भी होगा, थ्योरी भी होगा।
True, true.
लाइक वो ये सपोज तुम्हारा केस स्टडी वॉलेटिलिटी से आ गया, तो ये भी पूछ सकता है व्हाट इज वॉलेटिलिटी, एट द सेम टाइम वो ये भी पूछ
Hmm.
सकता है कि वॉलेटिलिटी कैलकुलेट कैसे करना है।
Right. And these calculators would be allowed, scientific calculators?
या इट शुड बी अलाउड। मैं प्लीज बात और उनसे करूंगा, मैं रिकमेंड भी करूंगा। विदाउट कैलकुलेटर हाउ विल यू डू? बिकॉज बीकॉम
Hmm.
एंड एमकॉम एंड एमबीए कैलकुलेटर इज मस्ट।
Right. The scientific calculator, right?
साइंटिफिक ले जाओ, साइंटिफिक ले जाना चाहिए। आई डोंट नो, सम पीपल डोंट अलाउ आई थिंक साइंटिफिक, बट यू कैन टेक साइंटिफिक कैलकुलेटर।
So it was allowed in the previous semesters.
इट वाज नॉट अलाउड।
It was allowed.
हाँ हाँ, इट शुड बी अलाउड एक्चुअली, एमबीए, एमबीए में इट शुड बी अलाउड। तो पेपर आई डोंट थिंक सो ज्यादा टफ होना चाहिए, बिकॉज जितना हमने कवर किया है मोस्टली उसी में से आएगा, ठीक है। तो ऐसा नहीं है कि आउट ऑफ द सिलेबस कुछ आना चाहिए, जो भी आएगा, जो हमने कवर किया है आएगा सब्जेक्ट में से, जितना हमने कवर किया है इसमें, ठीक है। और कोई डाउट हो तो बताओ आप लोग।
Questions also available.
जी आरती।
Sir, interpretation type questions.
इंटरप्रिटेशन, हर एक चीज और मैं बताऊंगा, अगर आपको लग रहा है कि कुछ चीजें कंफ्यूजिंग हो रही है। सो जैसे आज अतुल ने पूछा रिटर्न का कैलकुलेट करेगी प्राइस का, तो मान लो आपने प्राइस का किया, तो नीचे एक अजम्पशन लिख देना कि वी टुक बेस्ड ऑन द प्राइस या वी टुक बेस्ड ऑन द रिटर्न, ठीक है। वो लिख देना तुम लोग, कि अगर तुम्हें कंफ्यूजन हो रहा है कि हमें प्राइस के बेस पे किया जाए या रिटर्न के बेस पे किया जाए, तो अतुल प्लीज अजम्पशन में लिख देना नीचे कि हमने प्राइस के बेस पे
Sure.
किया है।
Sir, I had one question on this money market instruments that we
हम्म,
had done.
हम्म,
Are these tradable securities, the money market
ना
instruments?
ना, जनरली इंटरबैंक सिक्योरिटीज होती है ये,
Okay, they are
टेक्निकली।
all bilateral.
हाँ हाँ, बायलेटर।
Okay, they're not. Yes. And also this, we did this zero coupon bonds and deep discount bonds. Are they same or they're different? Zero coupon bonds and
सेम
deep
सेम
discount
सेम
bonds.
सेम
The
सेम
same
सेम,
thing.
वो
Oh,
कैरेक्टरिस्टिक्स आर सेम।
right. Characteristics are exactly same, right?
सेम सेम एग्जैक्टली।
So we can call it a deep discount bond or a zero
हाँ, यू
coupon
कैन
bond.
कैलकुलेट, एक्चुअली दे unnecessary they make people's life complicated, but they are
Right.
same amount.
Right. Okay.
Same as I was
Got it.
telling na, debenture, corporate bond, I don't know why they make too much difference, but it's still okay. Definition wise they try to make difference, that's it. So some things are like almost similar characteristics they have.
Right.
Okay. So anything else guys? मैं खुश हूँ, मैं डॉक्टर मोहित कुमार बन गया, मैं शो ऑफ कर रहा हूँ, बट मेरे को अच्छा लगा, 2 दिन से काफी सुकून वाली फीलिंग है। मैंने बिताए हैं आईटी के अंदर 6.5 years, तो आई कैन नॉट टेल यू गाइस कि हाउ पेनफुल दैट जर्नी बिकम समटाइम्स, बट
So
तो
to complete a PhD, it took 6.5 years, sir.
मेरा डुअल डिग्री प्रोग्राम था, 6 इयर्स लगा, मेरा डुअल डिग्री प्रोग्राम था, तो मेरा मास्टर ऑफ साइंस था पहले। तो
Okay.
2 2 साल इसे 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 डुअल डिग्री वी कॉल इट। पहले यू हैव
Right,
टू
right.
डू।
No, I am aware. I'm aware.
हाँ हाँ।
Yes.
फिर मेरा 3 4 महीने का बाहर इंटर्नशिप भी था, तो उसमें भी था, तो टोटल 6 इयर्स चला जाता है। तो अगर
Hmm.
पीएचडी है अकेले तो पीएचडी जाएगा आपका 5 साल के लिए। अगर एमएस प्लस पीएचडी है तो उसको जाएगा 6 साल के लिए। तो जो आपका स्टाइपेंड होता है, जो आपका
Right.
स्कॉलरशिप होती है, वो 6 साल की होती है। तो मेरा
Okay.
एग्जैक्टली 2 जनवरी 2018 को मेरा प्रोग्राम स्टार्ट हुआ था, एमएस प्लस पीएचडी। एंड भगवान की दुआ से आई वाज लकी इनफ कि मेरा 4 जनवरी 2024 को कंप्लीट हो गया था, मतलब थीसिस सबमिट हो गया था मेरा।
Hmm.
तो
Okay.
मेरा एग्जैक्ट स्टाइपेंड टाइम पे हुआ था। तो बट इट वाज लाइक वेरी, पता नहीं, बट पीएचडी समटाइम्स इट वाज गुड आल्सो, एक्सपीरियंस वाज गुड, but you feel a lot, like 6 years is not a small time.
Oh, definitely.
Yeah,
It's a huge
so
investment. Yeah.
या और कमिंग टू, मैं आ रहा हूँ शायद दिल्ली नेक्स्ट वीक। तो प्लीज आई शेयर माय मेल आईडी, मैं नंबर भी शेयर कर दूंगा। अब तो क्लास कोर्स ओवर हो गया आई थिंक, तो मैं शेयर कर दूंगा। यू गाइस प्लीज लेट मी नो, जिस जिसको भी आना है, कोई एक दिन वीकेंड में आ जाऊंगा, हम लोग बैठ जाएंगे। यू गाइस कैन डिस्कस अबाउट योर कोर्स, योर एग्जाम, एंड एनीथिंग यू गाइस वांट टू आस्क फ्रॉम मी यू कैन आस्क। मैं ये जस्ट बिकॉज क्लासेस अब ओवर हो गई, तो मैं एज ए फ्रेंड और अनऑफिशियली मैं आ सकता हूँ वहाँ पे, हम लोग बैठ के बात कर सकते हैं। Whoever wants to come and talk, they please come and we can discuss. Is it okay, Atul, or whoever like wants to come, please let me know.
Sure, sir. Yeah.
Okay. So I'll just communicate one date, like weekend only, I think would be preferred, right? So weekend would be okay, right, Atul, or like weekdays is also okay.
Yeah. I mean, I think our exams are starting now. I think
Okay.
from 31st the exams are starting, and till 23rd there are these internals and daily classes. But we can plan that.
Okay, I'll say no compulsion, but you just have some topics also, like so that it would be a bit okay. We covered something from your course also, and I can discuss regarding your course also. That would be good. We'll see how things turn out
Sure, sir.
accordingly. Like there's
Sure, sir.
no.
Yeah. Yeah.
ठीक है, तो with this, thank you so much. We are closing this session, and any doubt, anything, please do let me know and just drop me a mail.
Then
And
have you
today,
shared these decks? Have you shared these decks? Because we haven't received all the decks.
you haven't received what?
These PPTs,
Okay.
PPTs we have not received
Nah,
all of
PPT I did
them.
not share. PPT I did not share. PPT I did not share except Unit 1. So Unit 1, Unit 2 again I will share with you
Yeah,
guys. You
unit
just
one
share
I
it with them.
have. Unit one I have, but the rest I don't have. Yeah, okay, sir.
Rest I did not share because I
Sure.
told you like I had to do certain correction. Like I will remove these images because
Got you.
these are always copyright issues. And I will
Got you.
just refine the PPT a little bit and will share it with you guys. So you can share it with everyone and go with the PPTs.
Sure,
Okay.
sir. Yeah. Yeah.
Okay. Thank you so much, everyone. Thank you, Bhavna.
Thank you,
Thank you,
sir.
Atul, for being
Thank you.
active
Thank
and
you, sir.
being
Thanks very
actively
much.
involved with
Thank you
me in
so
this
much.
class.
No,
And
it
I'm
was a
extremely
pleasure.
so yeah, and I'm extremely sorry, like if I could not cover certain things or covered quickly. So please excuse me for that.
Thank you, sir.
Okay,
Thank you.
okay,
Thank you for this
okay,
long
okay,
session. Thank you for your time for this long session. Yeah.
Thank you.
okay.
Okay, sir.
Thank you.
Bye, sir.
Okay, bye, bye.
Okay, sir. Repeat.
Sir, leave on